Hey everybody, today we're going to be talking about Bill Ackman's $2.6 billion CDS trade. I'm Jackson Gordon.
I'm Elliot Brandler.
And I'm Aiden Danko.
Awesome. So let's start with an overview of this remarkable trade. A $27 million investment in credit default swaps, which were designed to transfer credit default risk, was made early in COVID-19 pandemic amid a peak market uncertainty. Within a month, this strategy yielded an extraordinary $2.6 billion profit, highlighting exceptional market foresight during a global crisis. So Bill Ackman's impact goes beyond his hedge fund performance. As an active investor, he is known for taking big stakes in companies to push for changes that boost shareholder value. His work with Canadian Pacific Railway, for example, drove major improvements in profitability and reshaped the industry. Ackman's education at Harvard College and Harvard Business School reflects a mix of theory and practical strategies he brings to his investments. He's known for combining sharp financial expertise with a focus on social good. By signing the Giving Pledge, he's shown a strong commitment to philanthropy, aligning his success with giving back. Ackman's bold strategies, like his controversial but highly profitable short on Herbalife, have made him a prominent and sometimes polarizing figure in finance. His ability to take calculated risk and drive change keeps him at the center of investment discussions as a standout in the industry. So what are credit default swaps? Well, credit default swaps, or CDSs, are key financial tools that act like insurance for debt, protecting investors from potential defaults. For instance, if an investor owns a corporate bond and fears a company might default, they can buy a CDS to hedge against that risk, paying premiums to a seller who compensates them if a default occurs. CDSs aren't just about risk management, they're also used for traders to speculate creditworthiness, profiting from changes in market perception. Their value depends on factors like credit spreads and the financial health of a debt issuer. While CDSs help manage risk, they can also increase systemic market risks. This became clear in the 2008 financial crisis, where their overuse and interconnectedness fueled instability. They're a powerful tool for experienced investors, but require careful regulation to avoid market disruptions. So, Ackman's strategic move during the early days of COVID-19 is a prime example of a sharp timing and foresight. While many focused on health crisis, Ackman quickly saw the economic risks and acted decisively. He took advantage of low-cost credit default swaps before the market grasped the pandemic's full impact. By targeting both investment-grade and high-yield bond indices, he hedged against defaults across different credit qualities. This early, cost-effective, and diversified strategy paid off massively, earning his fund significant profit.
This timeline captures the S&P 500's response to key events during the COVID-19 pandemic and its recovery. Initially, the market suffered a sharp decline over 30% as the pandemic unfolded. Amid rising deaths, restrictions, and election uncertainty, the market began to slowly recover, stabilizing after about 10 weeks. The Delta variant and inflation fears caused disruption, but the market rebounded within 7 weeks. Similarly, Omicron variant led to brief volatility with recovery in just 2 weeks. Overall, the S&P 500 regained its pre-pandemic peak in approximately 25 weeks in 6 days, reflecting the resilience and impact of fiscal and monetary measures. This trade showcases precision and timing. A $27 million investment in credit default swaps across investment grade and high yield bond indices ensured diversification and optimized returns. The position were initiated in late February 2020, anticipating economic disruption from the COVID-19 pandemic. Within weeks, they surged in value, yielding $2.6 billion. Ackman swiftly exited by mid-March to lock in the gains. Notably, the profits were reinvested into discounted high-quality equities during the downturn, preserving capital and positioning the fund for recovery and growth. This highlighted both tactical success and long-term vision. This chart highlights the exceptional timing and asymmetric upside of Ackman's CD hedge. By late February 2020, CD spread for CDXIG ITRAXX main and CDXHY were at historic lows, underpriced the pandemic's economic risk. Ackman acted decisively, acquiring exposure before spreads spiked in March, generating outsized profits and minimal initial costs. The strategy's asymmetry, small spread, increased yield, exponentially returns, and demonstrated precise timing and expertise in credit market dynamics. This move not only protected the fund during the crisis, but also provided the capital needed to reinvest in undervalued equities. It exemplifies a balanced approach to risk management and opportunity to seize the market. This slide highlights the 2.6 billion across from Ackman CD strategy across 3 key indices. CDXIG, focusing on US investment grade bonds, generated about 1.5 billion, reflecting the primary focus on lower risk instruments. ITRAXX main, tracking European investment grade bonds, added 745 million, showcasing the strategy global reach. CDXHY, targeting high yield bonds, contributed 493 million, capitalizing on market volatility, the diversification exposure across risk. So he maximizes gains, emphasizing the value of a balanced portfolio during market uncertainty.
So in March 2020, Bill Ackman's CNBC pandemic as it coincided with his CDS profits, raising questions about market manipulation. Ackman ended up defending his comments as a genuine health public concern, highlighting the ethical dilemmas for investors during crisis. Going on to my next slide, this slide highlights 3 key lessons that we can learn from Ackman's pandemic trade. The first is the importance of foresight in financial markets. Ackman's ability to anticipate COVID-19's economic impact allowed him to position his portfolio in a great position. The second lesson emphasizes timing. By entering the CDS market before volatility spiked and exiting at its peak, Ackman then maximized his profits. Finally, this trade demonstrates the value of hedging. Ackman used credit default swaps to manage risk and also capitalize on market uncertainty. Together, these lessons show us the importance of foresight, timing, and the strategy in navigating these volatile markets. Moving on, Bill Ackman's trade during the early days of the COVID-19 pandemic turned a $27 million investment in credit default swaps into $2.6 billion in profit. This success demonstrates his foresight, precise timing, and strong risk management, positioning Pershing Square for long-term growth. His strategy highlights the importance of proactive risk management. By using credit default swaps, Ackman effectively hedged risk and capitalized on market opportunities, balancing short-term gains with long-term portfolio stability. Ackman's trade was not based on chance, but on calculated strategy informed by deep market insight and analysis. And we look at this quote by Warren Buffett. He said, "Risk comes from not knowing what you're doing." And this kind of circles back to what Bill Ackman's strategy was during this time, how he knew it was going on. And moving on, we want to thank you for watching our presentation.
Thank you.
Thank you.